Paul, thank you so much for joining us here today. Certainly a lot for investors to weigh as they make some considerations for trading and other investment decisions today. We've got the coronavirus. We also have a Fed meeting and lots of very important earnings results. So we're going to start with you quickly on the coronavirus, because earlier in the week it was really weighing on sentiment. Things, however, turned around yesterday. What do you think is going to be the impact today and going forward? Are we too complacent about the possibility that this coronavirus could really dent the world economy?
Yeah, it's a very good question. I think most of the market is looking back to 2003 and what happened at the times of the SARS virus, if you remember. And we've already exceeded a number of cases. But on the other hand, there's a couple of kind of unknowns, really. One of them is that we don't know how long the incubation period is for the coronavirus, and we don't know whether there is one at all. In fact, the UK health authorities are denying that there's any form of incubation period at all. So what's really important, I think, for markets is firstly whether or not the length of the incubation period is able to be ascertained. If that's the case, then we can sort of take a judgment when the number of cases plateaus, how long the impact will go on and how much the number of cases are. But also there's a couple other things. One of them is that the mortality rate is much lower with the coronavirus than it was with SARS. So, the Chinese authorities this time have acted much more quickly than they did last time, much more decisively and much more openly with organisations such as WHO. So I think all of those things together mean that we are acting, I think, in a probably pretty sensible way. But I think that given the fact that markets have run up so much more than they had in 2003, the impact could potentially be a little bit greater.
And we also have this Fed meeting today. Of course, most market watchers are expecting that the Fed will maintain its sort of neutral, stable stance here. What should we be looking for, however, in the statement and in the press conference? We know that Fed Chairman Powell has been pretty zoned in on inflation and expectations therein. Also, a lot of action in the repo market, still making some investors a bit uneasy.
Yeah, I mean, the Fed has been pretty quick to try to dampen the concerns over repo, and I think they'll continue to watch that very, very closely. From the point of view of the statement and what the new Fed board is looking to achieve, I mean, I'm broadly in agreement with previous guests on this show, or the previous show, which is that there's unlikely to be anything significant from the Fed this year. I think that they will be watching very closely as to the global impact from the coronavirus and keep some ability to cut rates should they need to. I think their base case is not to do that. I think in terms of inflation, I think that looking at other economies across the world, which the Fed does, it will be very keen not to pull itself into a zero-rate style trap, which we've seen in Japan and increasingly in the Eurozone. So I think running things a little bit warmer in terms of inflation is something to which they won't be averse. And I think in terms of the sort of rhetoric that we see from the new components or the new members of the Fed, obviously we may have been seen as being shifting slightly, perhaps more in a more dovish direction, but we'll have to wait and see.
And before we let you go, Paul, can you give our investors a couple of ideas here of how to play the market, what to be focused on here?
I think there's a few dynamics around rotation which started to show themselves in the fourth quarter of 2019, which have reversed a little bit into 2020. And that's really mainly the shift from growth-style equities into value. And that's something which hadn't happened for a long period of time. The growth trade had become very crowded. And I think for the value rotation to reassert itself, we probably need to see something more in terms of positive momentum in terms of PMI and business confidence, and we also need to see the consumer continue to spend. So I think that's maybe the big question this year, and obviously last year we saw valuations run up significantly because markets did much better than GDP. So I think if those things can hold up and justify valuations, there's no reason why markets should be significantly weak. But I think the kind of returns that we saw last year may be difficult to replicate.